Welcome to the Broken Pie Chart Podcast, episode 298. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, more permanent than semi, if that even makes sense, Jay Pestercelli. Jay, what's going on today?
298, Derek. I know a number is just a number, as I like to age, but it feels like you're approaching an interesting milestone. Maybe 300's coming. I don't know. Maybe do something fancy for 300.
We'll think about it. But you know what else is fancy? I need to play from, I think this is the June 15th or June 14th episode this year, Jay. Hang on.
Okay.
And I'll give you first choice on this.
What am I, glutton for punishment? Keep doing this? Yes.
Yes, absolutely. You should keep doing it.
All right, I'm going to play the Gravestone Doji approach here.
Oh, boy. This isn't going to go well for you.
Yeah, no. Because we just decided we do things every day.
Here's one for you. I'll take the over on this. I think the market touches 6,000 by the end of the year. I have no idea if that's going to happen or not. But
yeah, look, I think that too. But I'll take the other side of it so that we can have fun, and we can hope you win that one too.
All right, Jay. Should we just name ourselves Nostradamus here?
Well, I will first off name you because the market touched 6,012 today.
Well, you believed it too. You just took the other side. You and I were both in agreement.
And look, it did it on November 8th. I mean, we got more than a month and a half to go to get there. I mean, it's been an obvious look. Let's state the obvious. The equity markets have reacted positively to both the election and the Fed call this week. So, it's been a fairly, in a lot of ways, a replay of 2016 post-election. And so the markets in a lot of different sectors, a lot of different asset classes are reacting the exact same way as they did, in 2016. So look, this is great. The market is another all-time high. That's good for people that are bullish, good for people that are in the market. So congratulations on winning another one of our, unofficial wagers. Yes. I don't know what I'm up to now. I'm like 0 for 4 against you.
I gave you first. I took it the first. But if I would have gone second, I said I would have taken the end. No, you and I both agreed because at the time, I think I listened later on. I won't play it over again. That people can go back and I'll link to the episode. But at the time, it was about 11.5% above where the market was. I think you even did the calculations. We talked about the probability of it getting there. I mean, it wasn't that unfathomable that it would get there. So, yeah, I mean, our target was probably lower than Tom Lee's.
Tom Lee, sure. I mean, I think he was one of the first to say 6,000. I don't know where he is at the end of the year at this point, but I think he's talking about even next year. I think I heard this morning on CNBC, 6,700 is in his realm to be touched next year. He thinks that, he's got a lot of reasons why, right? People aren't margin. They haven't overbought. They haven't overextended. They have the capital. There's a lot of other, tailwinds that he talks about on that interview. That was pretty good this morning. But I think, look, generally markets tend to go up, not all the time, but the market is up more often than it's down, a lot more often than it's down. So it's a loaded, unofficial wager that we had with each other because market tends to go, look, was the market eventually going to touch 6,000? Yeah, that feels like a probably good bet eventually. But
we said before the end of the year. Let's just be clear.
Before the end of the year.
How right we were. No, I mean, look, and by the way, we joke around about this. No, when we say, hey, I think it's going to go there, it's really just you and I talking and it's fodder and we love talking about the markets. It doesn't change anything that we do.
Actually,
the core thing we do is buy and hedge, right? I mean, that's...
Yeah, I mean, we even, going into the election, we had on some of our strategies, we had sold calls at a level lower than where it is today, right? So it was, hey, harvest some volatility going into the election, right? Using option tactics like call spreads to generate a little income while you're kind of waiting, right? That in our, if we were like really getting all in on this, it's going to 6,000 by the end of the year. You don't sell call spreads lower than 6,000, right? So it's, again, our process is one thing. The way we invest is one thing. And there are times where we're, re-hedging and locking in gains. And there's times where we're maybe putting risk on. We did have a strategy that, and this was not on your agenda for today, and as we normally don't go into too much detail, that, decided to add, had triggers come up, reading the volatility market, that added more upside exposure to the market right before the election, because that's what that strategy told us, right? So there's some strategies where we are, and it's all defined by the strategy, right? It's not a single market call that defines everything. That is kind of the beauty of all of the different strategies that we have. They all kind of follow their own rules. And sometimes they'll add risk, while the other one is selling risk away, right? So it all depends on each one of them. And I like that you bring up, we are long and hedge anyway, right? We call it buy and hedge. We are doing that regardless of what's going on in the market. And actually, Derek, right, as we hit all these highs, new all-time highs, you have to do something called rolling your hedges up, right? Because the protection you had, you've got to re-add it. It's almost like when you get a new car and your insurance has to change because that new car is worth more than the old one. You have to re-hedge, right? You have to kind of bring the protection up a little bit. And so those are the kind of things that we'll do when the market gets to these highs. Lock in those gains where you can, and use options to put hedges on in the portfolio that protect a good degree of the amount that we've appreciated this year.
All right, here's another one for us. I'm going to write this down that we're doing this on Friday, November 8th. We're recording this. Does the market touch 7,000 sometime in 2025? Now, I'll remind people as you're thinking about your answer, Jay, and I'm going to allow us both to be on the same side of this. It's not me versus you. We looked at the 1995 comparison, and the reason why we looked at that is we said, the market 1 year prior to the rate cut, the first one, July 6th of 1995, it was up over 27%. We were up over 27%. The 2024 rate cut. 1 year later, the market almost went up 21%. And I think when you and I had done the math, we went on the show, we went over these numbers. It was almost 7,000. Maybe in between Tom Lee's and 7,000. So does it touch 7,000 in 25?
Again, who knows what's going to happen, and will we hedge along the way? Yes. I almost feel though, like I want to say no because I've been wrong every time so that I can be ultimately right. Am I like double negative myself? Right. Cause it's almost like, if you make a change and you do that change, and because you made the change, something else happens that you think is going to happen. I do think the market touches 7,000 next year. I know that's another, 16% from here, but I don't know what, next year will bring. The market, I think the market's up 20, the S&P as the metric there is up 26%, I think at this point, year to date. I mean, that's a pretty aggressive year, especially after last year, but it would not be unheard of to see another double digit year after that. So I'm going to go yes on 7,000.
I'm going to go yes too, with the caveat of, as people like, don't trade off what we're talking about here. I mean, as we just said, we believe in staying invested, and in some of the core strategies, it either has hedges. So you're long and you're trying to get them a good amount of the upside, but you have hedges. Some other strategies where we have buffers in there. And Jay, as you eloquently mentioned, we have a number of strategies that do different things. So, but yeah, I mean, I'll let you know in a year. How's that? I'll let you know in a year.
I think you'll replay this at some point. You write this one down because you're going to be like, which was it? It's going to be that 298th episode where we talked about if we're going to touch 7,000.
I'm going to put an alert in. And then when I put the alert, I'm going to put episode 290.
Oh, yeah. So in your platform, you'll say reference episode 298. Very good. I love it.
Yeah. You know what else? This is a good lesson. I was going to say, the people who are always telling you it's going to crash 100%, like we've gone over that before, but Google Harry Dent or Robert Kiyosaki or any of these people. Like, it's coming into the election, Jay, we had a number of people, both inside our industry and, whether it be clients or advisors, saying, or either their clients were asking them, hey, should we get out of the market prior to the election and just let the dust settle? And in this case, you never know whether it's it's sort of a coin flip, yes or no. In this case, people who did that missed out on one of the better days of the year.
Well, I mean, we've talked about market timing is just really hard to do and get right. Yeah. I mean,
and you got to be right twice.
Yeah, the exit and the entry. I mean, it's why we say just hedge it. Like, that's an easy decision to make. And yes, maybe you give up a little bit because you put a hedge on, but you allow yourself to stay in the market. It's obvious to us. It's obviously important. I have a client who says, "Okay, you were right, but you never sell." And I told him, Gary, and if he's listening, Gary, we just re-hedge and move the hedge higher. I don't need to sell. I'm not going to time the exit. We want to stay long. Your time horizon is multiple years, not multiple minutes or days. So stay in the market. And, when you're nervous or you have a concern, you hedge it, right? And of course, the day you're the most concerned is probably, the day when others, when I say you, I mean the proverbial you, everybody, is the day where the market generally has concerns. So hedges are a little more expensive. But look, if you're hedging for an event, then hedge for the event and then move on and let your strategy continue to run. Don't put a 1-year hedge on if you're worried about the election results, right? If that's your concern, then put a shorter term hedge, and then you could decide later. You lock in your sale price. You know what? This is the neat thing about the puts that we use. When people say, "Well, how is that a hedge? How is buying a put a hedge?" Well, the put gives you the right to sell at a certain price. So let's just say I'm going to use a random, fictitious stock, XYZ. XYZ is trading at 100, and you say, I'm going to buy the 95 puts. It's 5% out of the money, right? 5% down. Regardless of where XYZ trades, you get to sell at 95. That's what the hedge does. That's what that put gives you the right to do. It gives you the right to put the stock to somebody else at $95 by a certain date. So if, stock, let's say it costs you $1 to put that on, because that is not free, right? Putting on a hedge is not free. So it costs you $1 to buy the 5% out of the money put, and XYZ goes up to 105 after the election, right? Now you may decide you don't want the put. You could sell that put right back at the market. Now you're not going to get $1 for it because there's less risk in the market, but you get something for it. Maybe you get 25 cents, right? However, you don't always have to take a total loss on your hedges. You usually can salvage something while there's some time left. But if the market drops to 80, 75, you have the right to sell your stock XYZ at $95, right? So now you think, well, I'm locking in this sale price at 95 regardless. That's why it's a hedge. It gives you the right to sell. This is in the most simplest forms, to sell that stock at 95 regardless of how low it's trading. And that's why that put ends up having value. And you can either trade the put or you can sell the stock. Typically what we like to do, because once you have this put in the money, that's what we call in the money, right? When the stock is below the strike of the put, it has what we call intrinsic value. What we like to do in that scenario, let's say the market is trading at 75 and you have the 95 put, that is worth at least $20, right? Like, isn't it? It's the market will give you a value of $20 because you could sell at 95 while the stock is trading at 75. That has value, right? And the market knows it has value. So you could sell that put for $20 and bring in $20 of cash and still own your stock, right? And you don't even have to sell it. You sell the hedge if you don't want to assign the put and deliver and put the shares to somebody at 95. You could just sell the put itself and get $20 of cash. Then you could decide what to do. By the way, you could buy more XYZ with those $20 and have more shares on the way up than you had on the way down. Or you could put it somewhere else, but that $20 is now in your pocket and you never even actually sold your shares. And if you think the market will rebound eventually, you get to ride those right back up. So when we talk about buying a put as a hedge, and I know I'm really going off here, sorry, Derek, but the idea of how it protects you is the thing that I wish people would just digest. In its simplest form, it lets you sell at a price that you get to determine. And that in and of itself has value. And that's what helps protect the portfolio.
Yeah, I mean, and it lets you stay invested, lets you stop worrying about timing the market. By the way, Jay, I may start a company and do an IPO and claim the ticker XYZ. It would
I don't
totally
think you
mess up
can.
everyone's
I don't think
fictitious
you can. I think
examples.
it's taken. I think it's reserved, right? I don't.
Oh,
think,
is it?
Yeah, I don't think you could do it.
I don't know. If
Yeah.
I win the lottery, I'll hire lawyers and get it. I don't know what I'll do with it, but I'll get it.
Yeah, you
the
get
ticket.
it, and then you could charge everybody a little money for referencing your stock in their podcasts.
Writing this down as an exit strategy. Okay, so
Alternative business ideas. Feed mayo to tuna. Okay.
yep, there we go.
There we
So
go.
just to round out the election stuff, because I'm sure other people are covering it way more than us. We'll get into some of the flows we're seeing. We're up 3.68% from the close on election day to the close today. By the way, that's like greater than 1,000% annualized. That's of no relevance, right?
If we keep doing what we
as-
did the last couple of days, we'll make it that market will go up 1,000%. So our 7,000 is an easy hit. You're saying?
Oh, of course. All right,
Yeah.
let's look at 2020. That was Biden and 11.48% from the close of election day to the end of the year. That's the end of the year. I looked at 2016, up 4.64% to the close of election day to the end of the year, although it did reach a high of plus 6.18%. 2012 was basically flat. And I went back and looked at the 1980 randomly. I didn't want to go back to every election.
The Reagan election?
The Reagan election, a high of 7%, and by the end of the year, plus 3.37%. So, I was just interested.
We're in the range.
Yeah, we're in a range. All right, let's talk about, everyone said, okay, we need small caps now because if we get the tax cuts stay permanent, or, let's say that they do more corporate tax rate, that tends to help the small caps. Looking at a chart here this is flows to IWM, and this is the day after election day. It was like almost 4 billion came into it. And prior to that, like the highs, the most recent highs were maybe 1.75 billion. Like this is a massive inflow into small caps, Jay. And then, the other thing is, this is kind of an obvious way to go for people, I think. Maybe.
Well, I mean, I think, and it was not us, but there were plenty of other sources that said, the small caps, which is IWM, were a proxy for a Trump victory because his policies will be more advantageous for smaller companies. And so, as soon as, the election was over, right? I mean, I think I was looking at it pre-market Wednesday morning, and I think I saw it was up 6.5% on that single day. But the money was flowing actually, even that evening, it was up over 6%. When I saw them announce Pennsylvania, the futures were up, over 6% in the Russell 2000 or the small caps. So yeah, this was, look, we've talked about small caps, liked is a strong word, but I mean, we've talked about the potential benefits of small caps outside of the election by itself, whether it was, the forward looking earnings, what the growth looks like there. We shall see if the policies of this upcoming administration are going to be positive for the small caps, but the market certainly reacted like it was a real big boom for small caps.
Yeah, a lot of flow though.
And money came, and yeah, it wasn't just, it got priced with low liquidity or low volume. This was like the most it's ever seen according to this chart you got here.
Well, most
almost
since
double.
2015.
Most. Yeah.
But, inflation. The problem with these charts, of course, is really you should inflation adjust it. But I'll leave that for another time. Like you can't show it. I mean, this only goes back to 2015, but if let's say this went back to 1970, like today's dollars compared to, you'd have to adjust 1970 dollars to today's dollars and do a.
That's because you're an academic and you like everything to be.
I'm not an academic. I happen to do academics on the side. All right, TLT flows. This one surprised me that TLT had the strongest flows since mid-October. And we know yields on the back end have gone up. We'll touch on the yields a little bit. But I don't know. I didn't really see
No,
this
they're
as
buying
a.
the dip, right? TLT, the 20 plus year Treasury ETF, was
Mhm.
down while yields were up immediately after the election. I don't know if it was I'm still trying to put the pieces together on that. Maybe it's like, oh, they believe policies will be inflationary, which, you and I have an opinion about that, which might be different. But I would say, so bonds, treasuries, long duration treasuries were down. And when you see all this money coming in, I mean, that's a buy the dip mentality, in my opinion, at all, right? You see large inflows into TLT. It's a buy the dip, Derek.
All right.
That's it.
Or maybe some people were like, "Oh, this is going to cause a recession, so I'll buy bonds." I have no idea. Who knows what people's motivations are? Or did the the 60-40 portfolios, if they had long duration in there, did they had to rebalance because equities went up so much? I don't know. All right. What about? I can't believe I'm doing this, Jay. I should read a listener email too. But
Go ahead.
I'm going to talk about Bitcoin. I don't know how you talked me into that. You didn't talk me into it. I don't know how I agreed to this, but
I mean, you can't stop yourself. You have to address the 800-pound gorilla. No, it's not 800. The pink elephant in the room. Let's talk about that.
This email, this is from Joe. Thanks, Joe, for the email. We like to get emails. You can send those to me at derek.moore at zegainvestments.com. That's Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to spell correctly, and that's DEREK.MOORE. All right, Joe, thanks for the email. He says, love the podcast. Probably his critique was more on me. He said, it struck me as really odd that those in the financial trading community don't know more about the MicroStrategy story and where it's going. Mind blowing, what the full potential. So I won't read the whole of it.
Is he talking about us not understanding MicroStrategy?
No, he said continue the good work. No, it was a positive email.
Good.
He says you guys should brush up on the MicroStrategy, and he's really probably referring to me because I am the Bitcoin skeptic. Jay, you did send me some Michael Saylor videos, which I watched.
It was a nice interview that he did right after earnings. Yeah.
I mean, essentially, it's and that's one. Actually, Joe mentions that. Look at the earnings stuff. I mean, it's interesting. I mean, he's basically issuing convertible debt to raise money to buy more Bitcoin, and in theory, if his stock goes up, the debt converts into shares. And you sort of, get rid of the debt. Tesla did that too. I mean, Tesla went up and got rid of the convertibles because the converts went into shares. So anyway, thanks, Joe. Thanks for sending the email. I'll continue my Michael Saylor Bitcoin education. But we got to talk about the flows. I think you mentioned to me, because I've banned it from my ticker screen. The Bitcoin made an all-time high.
Protest?
No, I made it in all seriousness. No, I made an all-time high. We looked at this is from Eric Baltunas at Bloomberg. He tweeted out a screen that the one-day flows, and I think the sum was something like 1.3 billion came into Bitcoin the day after the election. So pretty big inflows.
Funds, I think that's
Bitcoin funds. Yes, I don't know what the flows were. I don't know
how much Bitcoin was bought. that day when it was up 9 or 10% the day after the election. These are ETFs.
Yeah, so definitely the flows. This is part of the Trump trade, and I went back to there's a Politico article back in August, and you might remember that. President-elect Trump went to go speak at a Bitcoin conference. He went and spoke at the Libertarian conference, and he's gotten behind, the idea of Bitcoin. And one of the things that's been floated, I don't know if it's, I think there's a senator from Wyoming, and I believe Wyoming is a crypto hub because they encourage like the farms of servers and some things like that. They're crypto friendly, but it's this idea of, do we need a national strategic reserve? Think of like the petroleum reserve of Bitcoin. And the idea, part of the
we have reserves of all types of things in the United States, right? And I know we're not saying Bitcoin is a currency, but the U.S. has reserves for all sorts of stuff. You say oil, there's other currencies. Maybe Bitcoin makes sense.
Well, part of the idea is, well, you stockpile billions of dollars in Bitcoin, and they actually mention that the U.S. acquires Bitcoin in seizures. So if somebody is doing a crime and they seize somebody's car, they may seize the Bitcoin. I guess they hold it. So, but the idea, Jay, is that okay, this is the way we get out of debt. I'm reading from different articles, because we buy this Bitcoin, the Bitcoin goes up exponentially more than the debt, and eventually we sell the Bitcoin and get rid of the debt. That's kind of, so I don't know. I mean, strategic reserve of Bitcoin, is this why it's going up, or is just risk on?
No, this is that's not, I don't think that's the thing that's pushing it up, or at least not this week, right? I mean, to me, it's maybe a more friendly government towards Bitcoin, right? Is potentially the play here, right? I don't know what policy that would necessarily be, but we've seen it in Bitcoin based stocks, like we mentioned MicroStrategy. You could look at Coinbase. They all maybe it's just better for advancing the business of Bitcoin, right, under this administration. And I know what politicians say and what they do can be very, very different things. So I'm not even going to quote all the ways that President-elect Trump said he would support Bitcoin, because who the heck knows what he actually really does. But what I would tell you is that has got to be the reason, Derek. Like, that was, we watched it that night. I think I even, right as we were texting each other, I said, look at the price of Bitcoin, and you didn't. You refused. I did say it all the time.
I didn't even know where to find. I don't even know. I know where to find it, but it's not on my list.
By the way, don't you have a Coinbase account? Didn't you buy like a 100th of a share coin?
No, I got rid of it.
You did, and you got rid of it. That's good. In protest again, you won't even hold it. I gotcha. That's fun.
Yeah, no, I won't hold it. All right. So one of the other things too is, so Gary Gensler is the head of the SEC. I would say that generally he has been not as embracing of Bitcoin and crypto, and we saw that. Eric Baltunas has well chronicled this on Bloomberg about how the SEC sort of got in the way of these funds coming out earlier, the Bitcoin funds. But maybe that's part of it too. The thought is Trump will put somebody else in the SEC who's more crypto friendly. So,
yeah. Yes, great. That's great.
I thought you'd be impressed. I'm reading up on articles about strategic reserve of Bitcoin.
You told me, you're like, hey, this is how so anyway, we'll see how it all plays out. But I'm so impressed that you continue to bring it up on the podcast that you founded, and even in protest, you still are willing to talk about it, because I think people care about it. It's hard to ignore it. And nobody knows what the future is of Bitcoin, right? But it's obviously an interesting investment vehicle.
The one thing I'll say with Bitcoin is some of these coins, can I just say it? They seem like frauds. I'm a crypto idiot.
Now you're in a whole crypto universe thing, right? And like Dogecoin world, right? Like, what is this thing? Right?
Yeah. But Bitcoin has, sometimes when Bitcoin very easily could have sold off when it did a couple of years ago and just went away. But it did stick around, it did. So it's buyers and sellers. If more people are buying it than selling it, it's going to go up. It's the same reason why the tulip bubbles went up, because there are more buyers and sellers.
How long did the tulip bubble last, Derek? Interesting new information.
Not as long as Bitcoin has been going up.
Nope, it hasn't.
All right, let's switch back to bonds. Now,
so much more fun to talk about bonds than Bitcoin. You're right. No sarcasm there. Go ahead.
Well, one has. All right. Anyway, let me move on. So I could have played this one too. The episode we did right after the Fed lowered rates, I think I said, and you agreed and had some similar comments. Like, everyone thinks that mortgages are going down. Everyone thinks, now's the time to buy long duration bonds. And I remember myself saying, I don't see it. I don't know why everyone, this seems like it's going to be a crowded trade really quick. We know that since the Fed lowered rates in September 18th, the bond, a 10-year yield was 3.7. It was, what was it today? 4.37, right around there.
Right around there. Yep.
Yeah, right around there. And we've talked about how nominal GDP growth and what nominal GDP growth has been, and I've quoted it as, the rolling previous 10 years, sort of tells you around where the 10-year Treasury yield is. Somebody put out a chart on Twitter. This is from 314 Research. This might be Warren Pye's company, I believe. But somebody posted this. And it's an XY scatter plot. And on the x-axis is the nominal GDP growth rate. So nominal GDP is not the one that you see released, talked about on CNBC. That is the real GDP. So when you say GDP, it's just real GDP adjusted for inflation. Nominal GDP includes inflation. And so there's a relationship between nominal GDP and the 10-year Treasury yield. And basically over the last 5 years, I would say it's roughly, what is that? 6.3. Oh, he tells us in the chart. Yeah, 6.37 has been the current year-over-year GDP growth rate average over the last 5 years. And, there's sort of a band along the trend line. And I would say right now we're at the lower end of the band. But if we're right on the trend line, it's closer to 5%. So now that I've set that up, and hopefully people who can't see this, maybe I'll put this when we post it on our website.
You really should put out a data package, Derek. I really think people would love to see this.
I did it too. I didn't do it last week because I didn't have time, but the 2 weeks prior, I put our charts in there. So I'll try and do it this time.
Great. So this is a chart that basically helps you understand it's GDP versus Treasury yield, correct? Right?
Nominal GDP.
I know. I'm trying to I'm trying to make it as simple as possible for everybody here. So so you're right, nominal GDP. So basically what it's telling us is as GDP goes higher, the trend is you should expect higher rates in the 10-year Treasury. That's what this kind of trend chart shows as it goes up and to the right. And so what the idea here is, and we are on the lower end of the band here, right? When you look at all the other times where nominal GDP was around this, I'll call it 6.3%, right? You've got levels on the 10-year as low as, I'll say, like a 3.8 and as high as levels as 8%. And so when you look in this range, I think your point is, hey, if you think rates are high and they're going to go down, don't be so sure, because it would be unusual. It would be out of range to have growth like we have with a lower Treasury yield, right? We're on the lower end of this scale already. So if growth continues at similar rate, has this 5-year trailing average, you should be prepared for higher rates just on this GDP relationship alone.
Yeah, he goes on to say the estimate over the next 2 years is 5.2% annualized growth in nominal GDP, and he says that would equate to about a 4.45 10-year Treasury yield. So this is
higher than today.
Yeah, but this is growth. This is like a growth story. This is saying the economy is going to grow, which would be good. And if it grows, you should expect higher yields because the relationship, the R-square on this for the statisticians in the audience, 0.74. Like it's a pretty good relationship.
It's fairly tightly correlated.
Yeah.
Yes. Yeah. Okay. So for those of you who said, okay, rates have to go down because the Fed is going to be cutting the Fed funds rate, we've said this a million times. It does not necessarily apply farther out on the curve, meaning longer duration bonds like a 10-year.
We had sort of asked who's right, the mortgage rate or the 10-year Treasury. And what I meant there is, if you take the mortgage rate, if it's 7% and you assume, a normal 170 basis point spread or an average, it brings you down to 5.3. So everyone's saying, well, mortgage rates have to normalize and they got to come back down. But maybe the 10-year Treasury has to go up to get to the normalized 170 basis point.
Yeah, and look, I will say something else. Like, we've always talked about what is the path that the actual the yield curve normalizes, right? We've been inverted now for years. It feels like years. Is it years? It's got to be years. Where we've been inverted because the short-term rate is significantly higher than the longer term, or just even any rate. And it's higher by any amount than the longer curve, right? Usually, the farther you go out in time, you should expect a higher yield. So there's two ways that this inversion, I'm going to say, reverts or normalizes. We said, well, the near term could drop all the way down to the 3.5 range, or the longer end of the curve could go up. And if you look at this information here, there should be an expectation that the longer end of the curve probably has a bias higher than where it is today. And look, ultimately, Derek, I think this is a little bit of both. The near-term rate comes down because of Fed action, but because of things like growth and other pieces, the longer end of the curve can go up. And that's the way it ends up normalizing. And we may find ourselves in a year from now talking about a 10-year that is, dare I say it, closer to 5%. I mean, I think that's something that you should think about. Maybe that's what we make the next wager, right?
Oh, does it get to 5% or not? Hang on, I'm writing this down.
Before the next year.
What do you think? Or do you want me to go first?
You could go first this time.
I say yields touch 5%.
Oh, that's what I was going to say. All right, I'll take the other side. They don't. But I think they do. I just made the point that they probably do. So not probably. I think there's a chance that they do.
We can be on the same side. If we truly disagree on something, like where we would hypothetically, again, it doesn't change the way we invest necessarily, but we can be on the same side.
We're on the same side then. In 2025, 10-year touches 5%. I think that's a bold prediction.
Because of growth.
Because of growth, yeah.
Unless we have a recession, then yields are back in the 3 handle.
Perfect.
All right. See, I added that caveat.
Thanks.
That way I can be right on all facets, as I always am. All right.
Sure, we'll talk about it when you are.
Oh, yeah, because I only bring up the ones that I'm right.
Absolutely. You go deep into the market dynamics, and you've got a lot of expertise here. You've been, very accurate in the discussion of the analogies of, former years like 94, 95. This is all good, Derek. I think you should take the win. I mean, maybe not a Powell, I will take the win on, licking inflation, but, some sort of a win.
Yep. Next, maybe my next book, I'll put that in.
Yeah, you got it. Next book.
Well, I mean, I'm following the 95 path. So if I'm following that path, and I believe they're very similar, I'm sticking to the idea that what happens in the next year happens. I have no idea what's going to happen. I really don't. That's why
of course, nobody knows.
No,
right?
Of course.
I mean, it's funny. We talk about this all the time, and I'm going to quote one of our other folks that we work with. He said, look, you could give me tomorrow's headlines, and I'm going to tell you right now, you probably don't get the trades right? You can't, even if you know what the news will be, even if you know what's coming out, you still find yourself on the wrong side of the trade surprisingly often.
Yeah. All right, let's talk about the investment banks raising their S&P 500 targets. So it's one of those things. Do targets follow price, or does price follow the targets? And I think a lot of times the targets follow price. Like, nobody's at 4,200 by year end anymore. So Goldman Sachs had put something out. They said, we expect 11% EPS growth in forward 12 months that will lift the S&P 500 by 9%. Their 12-month target is 6,300. Now, this was, to be honest with you, I pull this stuff. Somebody posted this on Twitter. It could be, I don't know, this looks like it was in the last month or so, based upon where the chart is. They have EPS at 268 for 25. and 288 for 26. And if, 6,300 divided by 288, because at the end of next year, it would be the forward 12 for the forward PE. It would be a forward PE of about 21.87, where we were a week ago. So,
Derek, isn't this the same brokerage that said we were going to average 3% a year over the next 10 years?
well, that's over the next 10 years. They didn't say it wouldn't be 9%.
Okay, you're going to get 9, but then what? We're going to be like flat over the next 4 years? Like, come on, guys. Like,
so you're going to go up 9% and then go down 20 to get to, I don't know.
Yeah. I don't, they didn't say it was a flat 3 every year, but I'm just saying, like, this is, again, they're raising their estimate here for next year. I mean, at this point, that's a 5% gain from where we closed today. So, maybe that is it, right? I mean, this is 9%. So this was an older.
It was older. Yeah. This must have been prior to the election.
So it's on the way. So maybe it does all line up, but who knows? So yeah, like even so these estimates, so you're saying, hey, what comes first? Like what the banks are projecting and then the market meets it, or they adjust their projections based on what the market is doing. I think you're leaning towards when the market moves, they change their adjustments, they change their default assumptions. So wait, did you say there's no more 4,200? There's nobody.
I'm joking around. Wasn't there some guy who was like, "Oh, my year-end target's 4,200"?
No, it was 3,600 actually, and we talked about
this year.
Yeah.
Oh, at the beginning of the year.
Beginning of the year.
3,600. Okay, yeah. Here's the thing. We'll do our show. We'll do our predictions. We've got a number of new traders added to the Zega family, and we've got a lot of people who are going to make predictions with us. But you know what everyone's going to do. Let's say we close right at 6,000. I have no idea where we're going to close the year. What are people going to do? Well, they're going to take 8% or 9% and add it to it. I mean, so you'll see a cluster of it will be 6,200 to 6,700 will be the estimates.
All right.
And maybe some 50, somebody will be like, well, or, we're at 23 times forward earnings now. I think we take a breather. We wind up at 50. Yeah. So it would be like 56. A lot of
our traders think about PE ratio.
I'm not saying our traders. I'm saying the investment banks.
Yes. There you go. The fundamental investors.
It is funny though, like when you talk to, and we have a lot of former floor traders, they are, and you've visited, like you've talked to different floor, obviously we've talked to different floor traders. We've been on the floor, like they're focused on different things. Like they're looking at the implied vol. They're doing the rule of 16. They're like, okay, where do I want to be long or short? Where's my book at? Where's my exposure? All that stuff. You're right. Like they're not doing discounted cash flow analysis for sure.
No, definitely not.
But we'll see where they are. All right. Where else do I want to? I want to talk about volatility a little bit. And, we saw the put call ratio, something we follow. We look at the put call ratio on SPY options. We follow a standard deviation of that. We calculate it ourselves. And it was uncanny. Like people were loading up on protection, I think, before the election. Which, by the way, we just said, if you're worried about the election, the time to probably load up on protection was not right before the election when, the hurricane was right off the coast. When I don't mean like the election was a hurricane. I mean like the event was right on the doorstep.
The event was
Yeah. So, but it collapsed, Jay. VIX just poof.
Yeah. I mean, volatility in the market definitely sold off, right, from a 20 to a 15 fairly quickly, 21 to a 15. This put call ratio things, right? So this is all right, options, folks. I won't go. I've already done one, soapbox options education here, but basically there is an idea here that the ratio of open interest of puts versus the open interest of calls, the more puts would insinuate that more people are buying protection. We already talked about how they're protection, right? So the more puts that are traded and open, meaning active in people's portfolios, the more compared to the number of calls. In theory, it's not my theory, but this is the idea. In theory, it tells you like, hey, there's more people concerned, right? More people worried about the market selling off, and so that rising put call ratio is typically bearish, bearish, bearish. But when it gets to certain levels, when everybody's now buying puts, that put call ratio can signal capitulation. It could signal the pendulum has swung too far to fear and buying protection, because they're buying puts regardless of the cost. I just need protection. We're going into this event. Let me just buy it, right? So we watch for that rate of change. So the put call ratio is interesting. Generally, the higher the put call ratio, things feel more bearish. But we can't even substantiate that. Like, we have lots of data points where the put call ratio, which has been very high now for, a month and a half, 2 months. And again, I think we've been leading into this election. The market has still gone up, right? We just hit an all-time high. So it's not always indicative of a rising or falling market. It's indicative of, people, what they're adding to their portfolios. So when we look at that rate of change, right, we'll watch how fast it's happening. How fast is the put call ratio increasing? That to us is interesting. That to us tells us there's panic. That's the capitulation. That's the, be greedy when others are fearful mentality. So that's what we watch for in that particular data point. So don't watch just the put call ratio. Watch the change of the put call ratio each day. We have found that to be more telling and interesting than almost than many of the other things that technicians will watch out in the marketplace.
Can I do like a half hour on Gamma, Vanna, Voma, Charm?
Nope. Not
Veda,
if you want anybody
Vera,
to stay.
Second order Greeks.
I mean, you could talk to yourself in the shower. You can do it there, because that's the same number of people that are listening about Gamma.
Yeah, long-term listeners know that I am forbidden from talking about Gamma. But no, we have second order Greeks. You know that. Vanna, Voma, Charm.
Of course.
All those. We'll do an hour on those. That and the Himalayan debt crisis.
We say it sounds like we're saying it just to sound smart, but there's data to gather.
There are second order Greeks, but it's best done. Hey, let me ask you a question. Sometimes I wonder if people got out or didn't invest because of the election, and now because markets are going up, they're chasing it. I feel like that's part of it.
I mean so watch the inflow outflows on like the Qs, SPY, IVV. Like, watch that as an indication, like what you saw with IWM, which you present, what we talked about today. Watch the inflows to see if people are chasing or not. This happens all the time. You get higher highs and people are like, I'm going to wait. Let me wait for a little pullback. I mean, even I, knowing what I know and all the experience that I have, we had some people that we were doing some reallocation changes, and nothing to do with the election of itself, but it was time for them to take some risk off somewhere and add risks elsewhere. It was like, well, I don't know if I want to do it just today. Like, do I want to add equity exposure by the way, this is Wednesday going through my head. Do I really want to add equity exposure at this point? And the answer is yes, just do it. I'm not trying to time the market day over day. If you're bullish, if you have long-term investment plans, then, trying to figure out, do you buy exactly when the market's down, or, let me let it get a 1% pullback or a 2% pullback before I go back in. You may do that after a 6 or 7% run up, and you would have been better doing it off early. And so the mentality that we follow, when you've made the decision to invest or trade, do it then. Don't wait. The odds of it going against you are greater as you wait in time, especially when you're adding. So I don't know, Derek, I think there's just this natural proclivity for people to wait to buy a dip. And we all know that has been the story. Every dip has been bought. But, like if you sold going into the election, which there was really only one bad day that we talked about last week, going into the election, right? One, significant sell-off day of was minus 1.5. Nasdaq was down like 2.5. Like just over a week and a half ago. That's it. That wasn't very much selling, Derek, going in. It was impressive how mild the decline was leading up to the election. And, some would say that they might have followed the betting markets, which were calling for the Trump election. And I don't want to go too far down that path. We've talked about that already. But just saying that this, I don't know how many people sold going in. And for those that did, they probably have not bought back yet. It seems a little early, and they don't want to buy at the high because they weren't believers to start with. And not saying you have to like have this belief thing whether you're going to invest. If you're disciplined, that is completely irrelevant. That's all the point I'm trying to get across.
You know, before the bear market, I mean, the high was what, early January 2022. They're buying the dips. It worked for a tiny bit, but generally you had a new low, lower highs, lower lows.
Every quarter, it seemed.
Yeah. You know, I mean, markets have periods where, I mean, we've had historically bear markets. I guarantee, here's a guarantee, Jay, at some point we're going to have a recession and a bear market. Could be next year, could be 10 years. I don't know. But yeah, I mean, and probably what you'll have, I don't watch CNBC that much. I'm sorry to CNBC. They have nice people on there. We know some of them. There's people who go on there and are like, well, you know, I'm waiting till the market retraces. Like, you could have bought the market in August. You could have bought it in April. You could have bought it, you know, October of 23. Like, the market's been lower. So, you know, when people say, oh, I'm going to wait and try and time it, I mean, I don't know. I don't know what to tell them. It's just
you do know what to tell them. You tell them buy now and hedge if you're worried about a pullback. And guess what? You can always use your hedge to buy more later. That's what you do tell them.
Does Trump keep Powell? And I know he was asked during the press conference.
Yeah, he was.
He's like, no, he can't get rid of me.
Would you be asked? Would you resign if you were asked to? He said no. He said, can Trump fire you? He goes, no, not legally.
Could he make somebody else the chair?
I don't know. I mean, Congress does the appointment, correct? Is there a committee that appoints the Fed chair?
Well, no, the president appoints, and then I think Congress has to do it. But I'm wondering if they could. If there was an opening, he could. I'd have to look it up. I should have done my research on this, but people forget Trump put him into the position. Yellen was the Fed chair, and she stepped down early, I believe, right?
I think so. I'd have to revisit, but I know. I know she was before Powell. Yes, or
her term went, her term ended, but yeah, I don't know. I mean, I'll be curious to see who he puts in. Treasury Secretary is the other one.
What is the issue here, right? Like, I can't even remember why, was it he wanted him to lower rates in 2018? I can't remember what the deal is, why there was conflict there.
All of these, I mean, if you look at Yellen, you look at Powell and Bernanke, Greenspan, I mean, have they all been that different? I don't think so.
Who the heck could understand Greenspan? Yes, they're definitely different. I definitely would say they were different. Greenspan was a complete mystery. They've made this so much easier to have a little predictability in the Fed now. So I do think things are different. I think Yellen was better. Bernanke was fine, right? He did a great job. Nobody could argue about that. I could make the argument Powell's done a great job considering the environment that he was thrown into.
They didn't cause inflation. You and I agree on that. It was the fiscal side that caused the inflation.
Right. You call it gasoline on an open fire.
Yep.
But I also don't think they did much to solve it. I think we could say in some scenarios, in some sectors, they made it a little worse. But I get why they had to do what they did.
My point is, I mean, they lower rates, they raise rates. When everything looks like a nail, all you have is a hammer. And then Bernanke started it with some of the facilities during the financial crisis of, buying assets. Powell did it during the pandemic. I mean, they were buying high yield bond ETFs. Like, imagine that.
I remember.
So I think they keep taking it a step further, but in the end, they all sort of raise or lower interest rates. They buy bonds, they don't buy bonds, and in crises, they're coming up with more and more ways to be ingenious and buy assets and different assets. So, I think they're all fairly similar, but different. How's that?
Okay. You got it.
I don't know. I'm going to talk about gamma in a second. No, let's not do that.
Oof.
Any recommendations this week?
I'm not sure if I brought this up. I've been watching a show called The Irrational on Peacock. Have we talked about that already?
The Irrational. I don't remember this one. Was this the on Peacock? I'm Googling it right now.
Oh, yeah. So it's about a college professor. I did talk about it already. Well, anyway, still watching that. I think it's in the middle of its season now. Still watching as episodes come out. You know, kind of, it's okay. It's fine.
Is it a market weight, or is it it's not a strong buy then?
It's not a strong buy. It's, market weight's fine. I'm good. Yeah, fine. It's good to watch while you're killing time. I did watch, though, we like this one very much, Lincoln Lawyer on Netflix.
I like the movie, and I've been interested in reading the books. So I haven't watched the series, but my wife has watched the series.
Third season, I believe. That's the one that I watched. So yeah, there's 3. You've got some episodes queued up. It's a good one. We like that one.
But I might read the books first. You know, I'm an avid reader, so
I do know that about you. Yeah, there you go.
I've been watching Survivor, Jay. It's the only show I watch on network TV still. But what I do is I record the episodes. And towards the end of the season, I start to watch them so I can sort of batch them. I don't like just, watching it in September.
Waiting a week is for suckers. I know.
Yeah. So, what am I, watching Apple TV Plus? So, yeah, I like to batch them. And it's not as popular as it once was, so I don't have to worry about people ruining it for me or seeing something online. So
how many years have you been watching it? 20-something years?
Wasn't the first one like 90, is it 98?
I don't know.
99, 2000?
Forever. Yeah.
I give the people in the first year a lot more credit because it was new, and the idea of alliances and there was a lot of game theory in that. And now that the show has been on so many years, like there's sort of a playbook for it. People are more aware of it, but I still remember the first season. It was really good. All right.
It was a game changer, but it's, I can't believe it's still going.
That was also one of the first.
Keeping it going. Good work.
I'm the one. Yeah. No, do you remember too? Yes, I'm the only one. Well, maybe our Chilean listeners are watching it too. I don't know. I looked at the stats the other day, and yeah, we still got listeners in Chile.
So just keep talking about Gamma, and you won't anymore.
I think they'd really like a Gamma discussion. So, but can I tell you that the Survivor show, when that came on, I think that was the first time a network actually tried to put something new on during the summer, because that was a summer new show. It was the only thing on. It's kind of ingenious back then to do that.
Okay. Yeah, most stuff comes out in the fall. That's normal.
But now there's new stuff in the summer too.
Because they only do like 10 episodes now. Otherwise, they'd have nothing new to put out. Back in those, you think about the, 80s, 90s, early 2000s, you'd get 25, 30 episodes out of a season, right? That was a full-time gig all year round. That's not the case anymore, right? It's almost. Yeah,
I remember listening to Luke Perry on Bill Simmons' podcast, and they were talking about the number of episodes, and I think they used to shoot 30 might be the wrong number, but something crazy like that.
It's crazy now. It wasn't crazy then.
No, it wasn't.
The show would be a way of life.
Do you remember too, what was it, 1980, the Who Shot JR? Imagine you missed that.
Dallas.
Dallas. Yeah, Dallas.
No,
but the big episode was Who Shot JR, and you had to wait the whole summer to see what happened. Imagine if you missed that.
Those actors, this is so funny. I think those actors were in their early 30s. Didn't they look like they were 50, 60? I feel so old now when you look at those actors when they shot that series.
Yeah.
Good stuff.
All right. No one's going to remember Dallas.
All right. Next week is $2.99, and after that, it's $300, Derek.
We got to maybe we'll work on a guest. I don't know. We'll talk about that.
All right. Maybe we can have somebody.
Market's going to 7,000 next week, or it's going to 5,000. I'll let you know when it happens. See you, everyone.
Bye.
Take care.